Hello and good morning, everyone. This is Joss Banuelos with Gallagher. I'd like to welcome everyone to the webinar this morning. As a reminder that in order to limit noise distraction on the call, everyone in the audience is currently in listen-only or mute mode. However, we encourage you to ask questions as you have them by typing them into the question box on the GoToMeeting panel on the right-hand side of your screen. We will do our very best to answer all of your questions today, but in the event that we don't get to them all in the time allotted, I will have unanswered questions compiled into a Q&A email within the next few days. Also, a recording of today's presentation will be emailed shortly after the webinar ends. I'd also like to thank and welcome our presenters, Joanna Kim and Mark Dwyer from Trusaic. Joanna has over 20 years of experience advising clients on a wide range of employment, tax, intellectual property, and other related business issues. She holds a BS degree in chemical engineering from University of California, Berkeley, and JD from Loyola Law School. She was president of the Korean American Bar Association, Rising Star, Super Lawyers, co-chair of various subcommittees under the American Bar Association and the Los Angeles County Bar Association. Mark is vice president of data science for Trusaic. He is responsible for evolving Trusaic's analytics regarding pay, diversity, and data consolidation processes as the company continues to scale and expand its robust data and analytics solutions. Mark has 16 years experience in statistical analysis within class action litigation. He earned a PhD in economics from the University of Rochester, an MA in finance from the Wharton School, and a BA in physics from the University of Pennsylvania. He is a member of the American Economic Association and the Econometric Society. And with that, I'll turn the call over to Joanna. Good morning, and thank you so much for joining us.
Thank you, and thank you for attending our webinar. So today we're going to be discussing what employers need to do to navigate the pay equity movement. And towards that end, we're going to talk about four main topics: the pay gap context, federal laws and the political climate, fairly recent trends in state pay equity laws, and really sort of prime over the most important topic, which is proactive pay equity auditing. And then we're going to leave some time for questions and answers. Next slide. Okay, so let's first talk about the pay gap context. There are two dimensions to the pay gap problem. And the first one that we'll be talking about is the gender pay gap. Now, there's multiple ways of looking at it, but in its essence, it's the difference between what men and women are paid. As you can see from the two charts to the right, which are just examples of the gender pay gap, over the last 40 years, there has been improvement towards the pay gap. Unfortunately, that pay gap still persists. And if you look at a more general population, and these are surveys conducted by the Pew Research Center, you can see that in a more generalized population of all workers 16 up, you see that, as of 2018, we're looking at 85 cents to the dollar. If you look at a smaller segment of workers between 25 and 34, the gap is smaller with 89 cents to the dollar at the last time Pew Research did the survey, but it's still there. Okay, next slide. Importantly, in this gender pay gap, the charts that I had pointed to earlier are like overall charts for all workers. When you actually break it down based on education, you see that the gap is different depending on the level of education, and concerningly, the gap increases with more education. The only exception to that is workers with less than a high school degree. Okay, next slide. Now, the other dimension that we need to look at is the racial or ethnicity pay gap. And as you can see from the survey conducted by PayScale, you can see that the gap exists, but it's different depending on the race and ethnicity. And this This survey was conducted by PayScale, a company specializing in comp survey data, and they surveyed nearly 2 million profiles collected over a 2-year period. And this chart represents the uncontrolled racial pay gap by median income. Next slide. Now, in looking at just one of the racial pay gaps, the black and white pay gap, you can see that that is a severe and persistent pay gap, and it appears to be getting worse. The Economic Policy Institute conducted a survey of black and white workers over the last 19 years, highlighting the gaps in wages for 3 different periods. 2000, the last time the economy was closest to full employment; 2007, the last business cycle peak before the Great Recession; and third, 2019, the latest available data. And as you can see that with the 3 years, 2000 being in blue, 2001 being in dark gray, and 2019 being in light gray, the gap somewhat counterintuitively shows that it's getting worse, and this is the case no matter how you look at it, based on degree or based on different statistical measures. Okay, next slide. Now, when we've been talking about the race gap, and we've also been talking about the gender gap, gender wage gap. When you combine the two, the gap is even more dramatic, and not surprisingly, the impact differs depending on the type of race. Now, in this current ongoing COVID environment, the National Women's Law Center looked at a number of frontline occupations, and they found that the gap also differs on another dimension. So not just race, not just gender, but also by occupation. So while in all occupations the gap exists, the nature of the occupation also plays into how big the gap is going to be. And this really leads to the issue of diversity. Next slide. Now, what you see here is a typical example of how diversity plays into pay equity. So even if you actually achieve pay equity for gender or race, while this chart isn't specifically looking at it, even if you actually achieve pay equity in a particular job, what you will see typically is an overrepresentation of men in the higher paid positions, as you can see for this sort of executive category. And as you go down, you see the representation of men decreasing in the lower paid position. And so this is really sort of the diversity issue, where even if all the folks in a particular job are paid equally, the problem is there's a disproportionate representation of men at the higher positions, and a disproportionately high percentage of women in the lower paid positions. If you add in race and ethnicity, you have a similar problem. Okay, next slide. Okay, so now that we've talked about in general what the pay gap problem is, we want to talk about the legal and political climate framework to address the problem. Okay, next slide. There's two key U.S. laws dealing with gender and race ethnicity pay discrimination. The first is the equal pay gap, and that pertains only to gender. And then the second is Title VII of the Civil Rights Act, and that expands to also include race and ethnicity and a number of other protected classes. But at the heart of these two federal laws, which have been on the books for 60 years, what you see is a requirement that employers pay equal wages to men and women performing jobs that are substantially similar and performed under the same conditions in general. While that sounds great, there's also another layer of basically what are affirmative defenses for gender based pay disparities. And those four are seniority, merit, a system which measures earnings by quality, quantity of production, and then a fourth factor, which is a differential based on any factor other than sex. And it is this fourth factor, this fourth differential, that tends to create the largest gap in enforcement. We'll talk about that in a little bit. The other is sort of how equal pay, how you determine whether or not they're equal wages, and requiring substantially equal skill, effort, and responsibility, and that creates some limits in terms of which employees get to be compared with which employees. Okay, next slide. So in addition to those two federal laws, you know, arising out of Title VII was the Equal Employment Opportunity Commission, the EOC, and they've been around, 60 plus years. And in their instance, what they did was they created EEO1 reporting, um, and component one, which was designed to collect workforce, gender, and race ethnicity data from employers. And more recently, under the tail end of the Obama administration, perhaps the EOC recognizing the persistent pay gap some 50 plus years later, after it was first formed, they added in component two reporting. And we'll talk about that in a minute. But in essence, it's wage reporting in addition to the demographics. But with the Trump administration, that was halted and there was some litigation. And so it's basically ended after 2018. But now with the new Biden administration, there's, some speculation that this component two may be reinstated. Next slide. Other recent activity, perhaps recognizing the need to do more to achieve pay equity. There has been recent federal activism to advance diversity and transparency. And just earlier this year, there's been a number of actions. One was the FDIC basically calling on its regulated institutions with 100 or more employees to submit basically self-assessment for diversity policies and practices. Two congresswomen had sent requests to 31 of the largest U.S. investment firms seeking diversity and inclusion data. And also there was a recent hearing talking about diversity, equity, and inclusion, and there was an announcement to introduce Diversity Data Accountability Act. So there's been some recent federal activity to do more than what's been going on with respect to pay equity. Next slide. Now, obviously, we are in a new administration, and the Biden administration has immediately, taken action towards achieving pay equity. Among the things that Biden has done essentially on day one is to essentially rescind a number of Trump-era orders that do not advance diversity and pay equity, and instead issued his own orders, really sort of pushing pay equity and diversity. Next slide. In addition, the recent appointment of the OFCCP head, Jenny Yang, she has expressly indicated that gender and race pay gaps are on the top priority. Now, she was the one that introduced that component to pay data reporting when she was the commissioner of the EEOC. So this is part of why the climate seems ready for EEOC to, reinstate component to data reporting. Also with Kamala Harris as the vice president, she's really been, raising pay equity throughout her political career, and in her platform as a presidential candidate, she has proposed requiring companies to report wage data and basically penalizing companies that fail to meet pay certification standards. So now that she's VP, there's speculation that actions such as that will be advanced. Now, another thing to consider, next slide, is that with this current federal climate poised to embrace pay equity legislation, the U.S. can also look to a recent wave of international law that may accelerate federal legislation to combat pay equity. I won't go into the details of each one, but there are a number of particularly focused in the EU countries that have advanced either pay reporting, pay equity auditing, diversity, diversity requirements, and pay transparency. And importantly, all of these things have been happening just over the last few years. You can see it started with the UK in 2017, and then, there's just been a flurry of activity, and it still is going on right now. Next slide. Now, the international trend is not unlike the state trends towards pay equity. And these state trends, again, similar to internationally, they've been happening in the last few years. Next slide. Okay, among the state trends are expanding the definition of substantially similar or comparable work, akin to what we saw earlier under the Equal Pay Act as well as Title VII, and that allows more workers to be compared. And looking at it one way, it makes it easier for a plaintiff employee to claim that that person was not paid. There was pay discrimination. Another important aspect is limiting the affirmative defense against pay discrimination. And a number of states have basically required that fourth differential that I'd mentioned, where that's where the biggest gap in enforcement was. That fourth differential, what we're seeing is a significant number of states basically saying that factor has to be tied to job necessity, job related. Another area of recent activity is salary history bans, which basically prevent employers from asking employees what they got paid in their last job. And the theory being to sort of stop or perpetuate stop the perpetuation of just sort of systemic pay discrimination. And then also there's been a few states have imposed or provided for equal pay safe harbors, which employers can provide can receive some level of protection in litigation if they conduct a pay equity audit. Okay, next slide. Another area that's among the state trends is with respect to pay transparency and pay reporting. And you can see from this chart from the DOL which states have some level of state protection and which states don't. Pay transparency includes public disclosure, job postings. California also added in this diversity over the last couple of years, where there is a requirement of both gender and underrepresented communities to be on boards. Now, there's two that I wanted to focus on, SB 973 and Illinois SB 1480. SB 973 is California was the first state to require pay data reporting, and now Illinois just recently implemented its own pay data reporting and took it to another level. Next slide. So SB 973 is basically the EEO1 component to reporting, but obviously submitted to a California agency and not the EEOC. And it is a starting point for regulatory investigation of pay discrimination. And importantly, there's no accounting for those legitimate business factors that could potentially reduce these raw pay gaps that the EEO2 component to reporting reports. And there is this comment section that allows you to sort of explain it away, but it's not going to be sufficient. And another aspect of it is it really kind of highlights the lack of diversity in an organization by the report showing how many people are in all the different jobs and based on gender and race and what they're getting paid. So from a raw, even if you can sort of justify the pay gap, it doesn't address the diversity issue. So these are reports that are being submitted to the applicable government agency. In the California case, it is the Department of Fair Employment and Housing. Next slide. Illinois, just on the heels of California, instituted its own pay data reporting, and similar to California, it is an EEO1 component 2 style reporting, requiring also wage information in addition to gender, race, and ethnicity. Additionally, there is this equal pay compliance statement. And so this is something that an officer of the corporation has to sign, that they are in compliance with both state and federal laws, and kind of this affirmative statement that the company doesn't discriminate when taking into account legitimate business factors. So this sort of presupposes that you've conducted that analysis, and you also need to identify how and how often compensation decisions are evaluated and on what basis compensation is set. Next slide. So basically, as you can, from what I have been discussing with you, you see this kind of flurry of international activity. There's federal activism going on right now with the Biden administration, and states kind of filling in the void where the federal government had been absent over the last few years. And really what we're seeing is that standardization from a pay equity, transparency, reporting, those appear to be, quite imminent. And so with that, let me turn it over to Mark to discuss the importance of proactive pay equity auditing.
Great. Thank you, Joanna, and welcome again to our webinar participants. In a moment, we'll dive into the 9 essential elements that employers should look for in pay equity audit solutions. But just before we get there, I want to spend a few minutes on a few more reasons why it also makes sense to conduct a proactive pay equity audit. Next slide, please. So we know that pay equity audits help employers respond to the legislative and regulatory trends that Joanna just described and to reduce the associated regulatory and legal risks. But beyond that, there are a few more compelling reasons to start conducting pay equity audits. First, a pay equity audit provides the foundation for conveying to employees that pay is fair. Studies have shown that employees who see pay as being fair are more motivated, cooperate better, and exhibit both lower absenteeism and stronger attachment to their employer. Second, also as Joanna reviewed, pay transparency protections are becoming the rule rather than the exception. Increasingly, employees are being put in the situation where they see pay differences, but they lack the context to know why those pay differences exist. This is a problem for employers who have not successfully explained why those compensation differences are justified. Pay transparency, in the absence of an explanation of pay differences, can create the perceptions that pay is not fair, leading to the negative impacts of those research results we just listed, namely poor motivation, lower cooperation, greater absenteeism, and more difficulty with employee retention. As well, beyond employees, there are other stakeholders, beyond employees and regulators, that is, there are other stakeholders with an interest in pay equity. Pay equity matters to increasingly diverse investors, boards, and customers. In particular, investors are motivated to evaluate employers on the basis of their ESG, or environmental, social, and governance stewardship. Pay equity applies to 2 of these 3 areas, namely social and corporate governance responsibilities. In summary, there are multiple pressures beyond explicit pay equity laws and pay data reporting requirements that are increasing the urgency and the value of proactively evaluating pay for systematic pay differences by gender and race ethnicity in particular. Next slide, please. Okay, so here we get into the nitty-gritty. If you focus on just one slide from this section of the webinar, it would be this one and these 9 points. These are the 9 essential aspects employers should look for when evaluating pay equity audit solutions. This is the minimum checklist an employer should use to evaluate a pay equity audit approach that they are considering. So let's go through these. First, ensuring that the data are correct, accurate, and relevant is fundamental to the pay equity audit. Without this step, it's difficult for the data to be correctly interpreted and correctly used in the audit. We'll come back to data integrity, this issue, momentarily, because it's such an important issue, such a critical issue. But the question to take away from this is when you're considering a pay equity option solution, does the pay equity audit option assist with data integrity, or is it just left as leaving the data burden entirely up to the employer? And if so, that's a big burden, and we'll go into why in just a minute. Okay, the second issue has to do with what are called pay analysis groups. So a pay equity audit typically breaks the employees of a workforce up into different subsets of employees. Those are known as pay analysis groups. And those are analyzed separately, statistically. They're analyzed in with separate regressions, really. Many pay equity solutions offer little or no guidance on how an employer should construct these groups. Others, mostly offered by attorneys, attempt to offer the advice to game the the pay equity audit, by proposing empirically indefensible groupings that are meant to hide problems. Such strategies fool neither regulators nor plaintiff statistical experts. So the issue to consider here is, when you're considering a pay equity audit solution, is does that option leave the construction of these groupings up to the employer, or does it provide statistical evaluations and guidance regarding which pay analyses groupings are justifiable? So third, once the pay analysis groups are determined, the pay equity audit usually conducts regression analyses on each pay group to determine whether apparent gender and race pay gaps are actually due to differences in legitimate business factors that justify compensation differences. So legitimate factors reflecting differences in skill, effort, responsibility, and working conditions offer valid reasons for pay differences. For example, the pay equity audit can measure average differences in job level, tenure, location, shift, work shift, revenue responsibility, or client-facing client responsibility across different genders and or races, and then explain what portion of overall wage gaps are due to these differences. However, as explanations of pay differences, such legitimate business factors also need to demonstrate statistical significance. The process by which the statistical significance is examined is easily driven off the rails. It can be distorted and compromised if it's not done properly. When evaluating a pay equity audit approach, you'll want to know what safeguards are in place to ensure that the business factor roles being measured in explaining pay differences are going to end up being defensible. It should also be noted that the very fact that legitimate factors often explain much of the gender or race pay gap can be an indication that the organization's policies have a disparate impact on certain protected groups. For instance, as an example, is the average job level significantly different between whites and Hispanics? If so, then this job level difference can explain some of a Hispanic-white wage gap, if there is one. These differences may be due to, they may be outside an employer's responsibility if they reflect differences in training, background, or aptitudes in the candidates for various positions. But alternatively, they may indicate problems with promotion opportunities or promotion procedures. As a second example, does tenure with the employer vary significantly between women and men? So tenure is a legitimate factor. So if so, average tenure differences will likely explain some of a female-male wage gap. Again, though, there may be reasons for these differences that are outside the employer's responsibility, or such differences may indicate that there are problems with retaining female employees. The pay equity audit should provide measures of how big differences in illegitimate factors are between different genders and race ethnicities, and how much those differences matter in explaining pay gaps. This information allows the employer to prioritize which of these legitimate factor differences are the highest priority to examine for disparate impact based on the importance of those factor differences in reducing apparent pay gaps. Okay, after explaining wage gaps as differences in legitimate business factors, the fourth element of a pay equity audit identifies any remaining average pay disparities by gender and race ethnicity. These remaining pay differences, what remains now after legitimate business factors, those are pay discrimination liabilities, potential liabilities. The pay equity audit should allow the employer to view these potential liabilities from multiple perspectives. For example, in terms of their statistical significance, their implications for the overall annual compensation at the workforce level, and in terms of an hourly wage issues at the individual employee level, and at various steps in between, so like from a departmental level, a division level, and so on. Those should all be available with a pay equity audit solution. Okay, so the fifth element on our list here is that a pay equity audit solution should validate the regression findings. So the regression findings are really what are identifying these potential risks, these potential liabilities. There are at least 5 different dimensions through which a pay equity audit should assess the robustness of those pay disparities that are found through the regression analysis. A primary tool here is making cohort comparisons. So you want to ask, are cohort comparisons being made to assess the regression results? These compare what is a cohort comparison? It compares smaller groups of employees while focusing on just a couple of legitimate business factors that those employees have in common. For example, a cohort comparison could measure an average gender pay difference among employees at the same job level and within the same department. By performing a large number of such comparisons on different types of subsets, one can get a sense of how well supported the regression-based pay disparity findings are. Second, How sensitive, in terms of validation, a second issue is how sensitive are the findings to the inclusion or exclusion of particular legitimate business factors? So that's another feature of a proper pay equity audit. It'll give you some sense of this sensitivity. Regressions that have been tuned to reduce or even hide disparities often fail these simple tests, and these tests are easily conducted by regulators, like, for instance, the OFCCP or state regulators. Third, atypical values of legitimate business factors, like really high values or very low values, or of compensation amounts that are atypical, can have disproportionate effects on results. So the pay equity audit should examine gender and race pay differences both with those employees included and after identifying and filtering out those employees with such atypical values. So it's not, you don't want to throw away these atypical values and say you're done. You need to look before and after and see what the sensitivity is to this, to them. Do previously identified pay disparities continue to hold across that exercise? Then a couple of other dimensions I don't really have time to go into, but they're contextual assessments of the findings of the regression analysis. Do the regression results make sense within the context, the specific context of the organization? These fourth and fifth dimensions can help to prioritize which issues to address first if multiple disparities are identified. Okay, so that's on the validation point. That's a key piece of a pay equity audit. The sixth element of a pay equity audit we call root cause analysis. So this provides the employer with some direction as to the sources of pay disparities. Are there commonalities among those most affected by the pay disparity? So for instance, if we have we find there's a male-female difference, are women within women who are affected by the pay, who have a pay disparity, is there a subset of women with some sort of commonality, and they are the ones who are most indicative of showing an underpayment? So that would sort of help to drill down on what could be driving the pay disparity. How do pay disparities vary across time? How do they vary across location and organizational level? By answering these questions, the pay equity audit assists the employer in identifying causes, not just the symptoms. Okay, the seventh element of a pay equity audit should deliver assistance to the employer with developing remediation strategies. So it's not just enough to identify problems, you want to have solutions. In addition to quantifying pay discrimination risks, the pay equity audit should allow the employer to examine alternative strategies for addressing those risks in terms of their relative costs and effectiveness. And like data integrity, this is a big issue. We'll spend a little bit more time on this in another couple of slides. But moving on, number 8, if pay disparities is monitoring. If pay disparities by gender and race are identified, the proper pay equity audit also allows the employer to monitor those pay differences over time. If compensation adjustments have been made in an attempt to solve those disparities, this ongoing monitoring can track progress. There's nothing more frustrating than making compensation adjustments to address pay disparities only to find that they have reappeared a year or two later. When you conduct another annual audit or biannual audit. Ongoing monitoring, in contrast, reduces the likelihood of such surprises. As well, changes in your workforce turnover can affect gender and race pay disparities. Ongoing monitoring picks up these effects due to new hires, to separations, and to promotions. Okay, lastly, but not leastly by any means, the predominant approach to proactive pay equity auditing is to consider the audit as a component of legal advice. It's prudent for employers to ask their internal or external counsel for advice regarding litigious and regulatory risks raised by the trends that Joanna identified. But to be meaningful, that legal advice needs to be grounded in the specific compensation decisions an employer has made. It has to be grounded in what their compensation is. A pay equity audit that is directed by the employer's counsel provides the analytic and quantitative foundations for that legal advice. Conducting a counsel-directed pay equity audit for the purposes of receiving legal advice means that the findings of the pay equity audit can be legally protected. A pay equity audit solution should be able to maintain the privilege protocols that are agreed upon by an employer and their legal counsel. Okay, so those are the 9 key elements, and with that, we'll just drill down a little bit further on the next slide, please. Okay, pay equity data. So let's now focus a bit more on the first of the 9 essential pay equity audit elements we just reviewed, and this is data quality. Data quality is, as we've tried to illustrate here, the elephant in the room that the pay equity audit solutions all too often ignore. As you might expect, data quality is of paramount importance to the pay equity analysis, which is fundamentally empirical, based on data. The reason it is so often ignored is it is hard to get right. Data quality is one of the most resource-intensive aspects of the pay equity audit, particularly for employers who decide to conduct their own pay equity audit internally. Many HR professionals are unaware of the inconsistencies and ad hoc changes that lurk in their payroll systems. The inexperienced can easily get lost in the weeds of trying to understand exactly what employees have been compensated for. Such data problems are not only time and resource intensive, they make pay equity audits less accurate and can lead to remediation strategies that are off target or inefficient. Sometimes data relevant to setting compensation is not contained in traditional databases. Information not contained in structured databases is sometimes referred to as unstructured data. That's why we make that distinction between structured and unstructured data. Some examples of such unstructured data are prior experience and education, if they're only found on resumes, performance reviews that are only found in Word documents, job responsibilities that are only listed in job descriptions, and again, in some sort of a document. If these data are relevant to compensation decisions, they should be included in the analysis. Converting these sources into data that can be included in the pay equity audit is part of the data expertise needed to perform a successful audit. So given time limitations, we can only touch briefly on the 5 remaining dimensions of data quality that we've outlined here. So to begin, the first 2 characteristics of completeness and consistency span several issues. For example, there are many different types of missingness. A specific field, like relevant experience, may only be readily available from some employees' records and not from others. Other data that might be relevant to compensation, such as measures of additional effort and contributions made by some employees, might be wholly missing for all of the data. We just might not have that information, even though it influences compensation decisions. Data inconsistencies often arise when bringing together data from different systems as well that were originally compiled, where the data was originally constructed for other purposes, such as between systems recording only current positions, locations, and responsibilities, and different positions held by the same employees over the time period being examined. So a critical problem that we often deal with is where some of the data is just what is the situation today, but we're trying to help the client to look over the last year or so. And so things have changed and we need to know historically what things look like. So making sure we're not mixing and matching today versus 6 months versus a year ago is an important piece of data integrity. Other data may simply be implausible, such as we've seen prior experience that implies an employee started working at the age of 11, or a particular employee is being paid for months on end with no hours worked, and that's obviously just something that needs to be addressed. Developing strategies for addressing these issues requires a careful review of the data. As we discussed on the last slide, it is important to identify atypical or anomalous data, such as atypically long tenure with the employer or compensation that is unusually high or low, not just because they may be wrong, but also because such data can have disproportionate effects on results. So that's why we atypical data are often highly influential data. So prior to conducting the pay equity regression analysis, atypical data should be identified and revalidated to ensure that they're correct. So the last 2 points here on data quality are proper interpretation and ensuring that differences in how compensation is structured across the organization are respected. This means working with an employer to ensure that the timing of compensation decisions is reviewed, the potential factors that are considered in those decisions are fully articulated, and that the history of the organization, among other influences, for instance, mergers and acquisitions, are taken into account in constructing the pay equity audit. A pay equity audit solution should be vetted for the degree of assistance with these elements of data quality that the solution will provide. Next slide, please. Okay, so we talked about data, and we've talked about the 9 elements. Now we're skipping down to the remediation issue, remediation as part of the pay equity audit. In the event that pay disparities are detected, the next question is what to do about them. By multi-pronged remediation strategies, we're referring both to compensation and to non-compensation responses to the findings. In terms of non-compensation based remediation, These further divide up into determining whether there are deficiencies in the data analyzed and a further investigation of policies and practices that are giving rise to unexplained pay differences. The validation and root cause elements of the pay equity audit that were on our main list there can help facilitate with these non-compensation responses to disparities. In terms of compensation-based responses, the pay equity audit should provide tools for evaluating the impact of proposed compensation adjustments. That is, the audit tool should allow the employer to contrast alternative approaches and budgets and measure their likely effectiveness. Compensation-based remediation strategies are evaluated based on a pay equity predictive model for each pay analysis group based in the regression analysis. These predictive models allow you to examine how your pay equity situation would change under various hypothetical compensation adjustments. An employee is considered potentially underpaid with respect to these models if their pay is below their predicted pay, and considered potentially overpaid if their pay is above their predicted pay. The audit solution should allow the employer to drill down to the employee level to see how their actual and predicted compensations compare, how strong the empirical evidence is that their gender or race of the employee that the gender or race that the employee belongs to is underpaid. Compensation-based remediation strategies fall into two broad types, an all-class approach and an impact class approach. Both focus on remediation within pay analysis groups with class disparities. By class, I mean gender, race, ethnicity. So by impacted class here, when I talk about an impacted class strategy in a moment, we're referring to a gender or race group with an identified pay disparity or pay disparity or pay difference that cannot be attributed to differences in legitimate business factors. At the individual employee level, an employee can be potentially underpaid or potentially overpaid, regardless of whether they belong to an impacted class. What distinguishes impacted classes is that when unexplained wage differences for those employees are averaged, the result is a non-negligible and statistically significant average underpayment to people in that group. Under the first all-class approach, the budget for addressing pay disparities is distributed among the most underpaid employees, regardless of whether they belong to an impacted class. That is, the all-class approach raises compensation regardless of whether an underpaid employee is in a protected class with an identified pay disparity. So for example, in a black-white pay disparity, the all-class approach applies wage increases both to black and white workers who are underpaid. Under the second impact class approach, the budget for addressing pay disparities is focused only on underpaid employees in impacted classes. In the case of a black-white racial pay disparity, again, the impact class approach would focus resources on raising wages for the most underpaid workers who are of the impacted race only, that is the race with the pay disparity. Neither approach fits all organizations. It's possible to blend the two approaches together. In general, the all-class approach is less efficient in reducing unexplained gender and race pay differences. The more efficient impact class approach is often feasible when coupled with remediation steps that are addressing root causes. For example, if compensation has been tied to performance reviews and those reviews are found to have been biased, the impact class approach is effectively adjusting compensation to address those review biases, as opposed to compensating employees on the basis of their gender, race, ethnicity, which of course is illegal. The stronger the identification then of the root causes of the pay disparity, again, the pay equity audit should be assisting with this, the lower the risk of potential reverse discrimination claims with a more targeted and more efficient impact class approach. So again, when you're evaluating a pay equity solution, it should also allow for a phased approach to compensation adjustments, not just a one-shot deal. Once implemented, tracking the impact of those adjustments over time should be part of the pay equity audit solution as well. Next slide, please. Okay, so with all that, as I've tried to outline on the previous slides, it should be apparent that pay equity audits weave together expertise from three essential areas, which we've represented here as a triangle, the triangle of trust. It is unusual for employers to have in-house expertise in data analytics and regulatory expertise, and to have those combined and interwoven in a way that's appropriate for pay equity audit analysis, for pay equity auditing. For this reason, we recommend employers to consider external partners when undertaking pay equity audits. By their nature, pay equity audit solutions also measure employee diversity as well as pay issues. While we don't have time to go into it, in terms of meeting social and corporate governance responsibilities within the ESG framework, employers should look for partners who also provide employee inclusion sentiment and workforce dynamic analyses to complement the diversity and equity insights that are offered by pay equity auditing. Next slide, please. Okay, so how do employers start with all that? Well, a good place to start is to simply measure pay gaps. Such a pay gap risk assessment, just looking at pay gaps, measure the average pay differences by gender and race ethnicity for each location and perhaps using EEO1 job categories. This provides employers with a sense of the potential risks that a pay equity audit could address. Measuring pay gaps while accounting for EEO1 job categories and establishments doesn't jeopardize privilege, because remember we were talking about attorney-client privilege for most employers, because such pay gaps are readily calculable from payroll data and EEOC filings. So that data is pretty easy to access, and these are not sophisticated calculations. For that reason, pay gap risk assessments can be conducted before legal privilege safeguards are constructed. But after conducting a pay gap risk assessment, the results should be shared with the organization's leadership, including HR and general counsel, to develop a consensus as to what the next steps should be. Usually those next steps would include a pay equity audit. So after leadership has committed to undertake a pay equity audit to explain pay gaps, most employers establish at this point the protocols to protect against compulsory disclosure of a pay equity audit. Part of these protocols involve deciding who has access to the results of the pay equity audit. Finally, evaluate different pay equity audit options. Here, it's important to keep in mind the 9 essential elements of a sound pay equity analysis that we reviewed a few slides ago. If you're considering a do-it-yourself solution, evaluate your internal resources with respect to these 9 elements and the 3 specializations of expertise that we just mentioned. If you're considering a partnership, ask the prospective partner about each of these 9 elements and make sure you are satisfied with the answers. So, for instance, is the prospective partner set up to adhere to your privilege protocols? Will the partner shoulder much of the work of collecting, validating, and interpreting your data for the purposes of pay equity auditing? Will the partner test and recommend defensible divisions of your workforce into pay analysis groups? Will the partner not only measure group differences in pay determinants, but flag potentially disparate impact issues? Will the partner provide diversity metrics and inputs that are ready for regulatory filings? Will the partner quantify pay discrimination risks at a variety of levels, not just give you the top line numbers? Will the partner provide multiple validations of results, assisting with setting priorities? And will the partner measure the cost and efficiency of alternative and flexible remediation strategies? Will they investigate the root causes of pay differences, and will they provide ongoing monitoring of outcomes? So with that, that's sort of a good roadmap for starting, and I think we can turn to questions.
Thank you, Mark. So we have a few questions. First question, what is the difference between a pay equity audit and a compensation analysis? Mark, can you answer that?
Sure, I can take a shot at that. So pay equity audit is focused on internal pay equity. And compensation analysis, while it could be used synonymously, often refers to what we might call external pay equity, which is looking for the degree of competitiveness of offers and compensation internally to the firm with respect to the external labor market.
Okay, another question, does the diversity on boards include nonprofits? I can answer that one. We were talking about diversity on boards really in connection with California, although there is pending legislation in Germany as well. But for now, it only applies to publicly traded corporations. So if you're a nonprofit, that should not apply. Another question, how concerned should a company be by submitting its California pay data reporting without conducting a pay equity audit? Mark, can you answer that?
Well, sure. The reporting for California is akin to EEO1 Component 2 data reporting, and it does not take into account legitimate business factors that may account for or reduce the apparent pay gaps. The California report provides for a comment section, but it's unlikely to be satisfactory to demonstrate that there are no real pay disparities. So without conducting a pay equity audit, you won't know what those apparent pay gaps are actually revealing. So it's better to have one of these done ahead of time if it's possible. Have a pay equity audit done before filing.
Okay. Another question. How often does a company need to do a pay equity? If I have a company that has employees that presumably are being hired or leaving or getting promoted or what have you, how do I address that when, with the pay equity audit?
Sure, it's a good question. So in general, a pay equity audit should be conducted annually with ongoing monitoring to address those very changes which we touched on earlier, because the gender and racial mixes at different levels in the organization are going to be changing over time, and particularly depending upon how rapid that turnover is. It's certainly important to conduct a pay equity audit at least annually.
Okay. Okay. Are salary negotiations considered a business factor that justifies pay disparities?
Uh, well, legitimate business differences, as we said, have to be accounted for. A salary negotiation is not generally considered a legitimate basis for compensation differences. Unless differences in, again, legitimate business factors align with a negotiation difference. In other words, someone's labeled as a better negotiator, but they actually were bringing in a lot more experience, right? That
Right.
experience counts as a differentiator. The fact that they negotiated a better deal does not. So if it's just purely due to negotiation or whether the employer was being tough that day or not, the employer would be liable for the pay difference.
Right, and I want to also add that, I mentioned these sort of salary history bands. That's obviously often had gone into negotiations in salary, for salary. Like a typical example might be employer might say, well, how much were you getting paid at your X job? And use that as a platform to figure out how much that candidate will need to get paid in order to um, encourage that person to move over. So that's historically has been the case, but in many jurisdictions, that's no longer allowed. You can't ask a job candidate how much he or she was getting paid at their prior job, and so that obviously sort of, you know, um, makes salary negotiations even less of a business factor, if you will, or at least that can't be part of the salary negotiations. Okay,
Great
next
point.
question. For a small company, how important is it to conduct a pay equity audit? The example was less than about 50 employees.
Sure. It's still important for smaller companies to conduct pay equity audits. It's the issue of determining pay analysis groups takes a different twist for smaller companies, but it's still important to make those to do a pay equity audit. What we see in smaller circumstances is that we switch to a different technique of interactions of legitimate business factors instead of constructing completely separate statistical analyses, and that's because we're really up against the threshold of statistical power with those smaller employers. But it's still worthwhile to conduct a pay equity audit.
Okay. Should performance-based rating algorithms and its results be incorporated in pay equity strategies?
So I'm not sure what the questioner means by performance-based rating algorithms. So let me try to unpack that a little bit. So performance reviews, if they're used in compensation decisions and they're accurately reflective of the performance of the employees, those should definitely be factored into the pay equity audit. Whether there are some metrics that are sort of automatically generated on people's activity, but they're not. It really would depend upon whether the people that are making compensation decisions rely on them or not. And if they do, then they would probably be, they've been constructed with the premise that they are measuring something of legitimate business value to the company. And so under that assumption, and the fact that they're being used by compensation authorities, people setting the compensation decisions, then they should also be, these sort of more automated or more structured measures would also be included in the pay equity audit. Now, they would be ripe though for questions about disparate impact. Okay, about whether those automated scores, whatever they may be, are truly in alignment with business necessity. Because as I tried to describe earlier, when a factor explains part of the pay gap, it means that that there's a difference between men and women, or between different races and ethnicities in terms of the level of that factor. And so if some sort of automatic scoring algorithm is giving women or minorities a lower score than others, you want to make sure that that's picking up something that's of absolute business necessity.
Mark, I wanted to ask you just as a follow-up. So if you know, one of these factors sort of explains the pay gap, is that enough, even if in fact the employer didn't actually take that into consideration, but it just so happens to sort of empirically align?
No, and that's a great great question, Joanna. Yeah, we really encourage, and part of the pay equity audit process is the documentation. And so if you just happen to find some factors, and you're sort of throwing things at the wall and seeing what sticks in terms of trying to
Hmm.
explain pay differences, that's not going to cut it. There has to be an established, ideally, an established and written policy that indicates that we were relying on these measures for compensation decisions.
Right, and sort of echoing that, so for Illinois, their pay data reporting, which really kind of, is like California pay data reporting on steroids. What it's asking as part of their certification is this compliance statement, which identifies what factors were actually considered and how the metrics were applied. So it's not just the reporting, but the mechanics of the reporting, as well as what legitimate factors were conducted. So for California pay data reporting, you could just go ahead and submit the report. I think that is, somewhat risky to do, because you're basically submitting this report without knowing what it reveals. You want to know that, and it's showing the raw pay gaps without considering these legitimate business factors. But then switching over to Illinois, it's asking you to tell the agency what those legitimate factors are, and how the mechanics were done to come up with the various wages. And I didn't get into it in detail, although the slides make mention of it. Part of the uh, Illinois law is not just the pay data reporting, but also there's also this public facing employee demographics information that has to be submitted. So it's just like more information that you're actually providing to the agency. So it's important that you know what it is you're doing. A pay equity audit is so important, so that when you're doing the reporting, you know what you're reporting. And as Mark had mentioned earlier, like in California, there is a section for comments. But what are you going to comment if you don't know what it is your data revealed? You're sort of submitting it blindly. And importantly, even though, for Illinois, the public facing demographics are actual data that can be submitted, that will actually be published by the Secretary of State on their website, apparently like 90 days after you file it. That data, the data for the California counterpart, is not submitted publicly. It's submitted to the Department of Fair Employment and Housing, but
Could
that
I
doesn't mean that a plaintiff can't get it through a subpoena or what have you. And certainly, California agencies have the authority to enforce pay equity, pay discrimination laws. Yes, Mark.
just on the California, it's likely that DFEH is going to go after employers who stick out relative to their industry, their geography, their size, and you don't know how you compare on those dimensions, right? Without
Right, right.
conducting
Well,
a pay equity audit.
right, and the DFEH has all the data to run those analytics now
That's
and
right.
determine what those benchmarks are.
Yep.
Okay, I think that's all the time we have. So let me turn it over back to you. Jocelyn?
Thank you both. That was some wonderful information there for everybody on the line. As I mentioned earlier, I will send out the recorded version of the webinar in a couple of hours later today. And thank you all for joining us. Have a wonderful day.
Thank you.
Thank you.